First off, let me say this: thank you for being here. I don't take your time for granted, and I'm glad you chose to spend a few minutes with me today. What we're about to talk about isn't just theory or headlines, it's the kind of stuff that shapes entire lives, families, and futures. Now, I've been around long enough to see the economy do its dance up, down, sideways, and sometimes straight off a cliff. 14 recessions have passed through my lifetime. 14 real economic storms, each one loud and messy in its own way. And if life gives me a little more time, I'll probably witness another one or two before I'm done. That's simply how the world works. The economy expands, and then it cools off. People get overly confident, then suddenly fearful. Boom, then bust, then boom again. It's as natural as the tide rolling in and out. No matter how much we innovate, or how many experts shout predictions on TV, none of us can freeze that tide in place. But here's the good news, something most people overlook. Even though we can't stop the cycle, we can prepare for it. And that preparation can make the difference between panic and opportunity, between barely hanging on and coming out stronger than before. What I've noticed is that most folks treat recessions like some kind of lurking monster. The moment the headlines turn dark, or a friend loses a job, fear kicks in. Instinct takes over: pull back, hide, stop everything. And I get it, fear is loud. But after more than 70 years of investing, here's the truth I've seen play out again and again. Recessions are not just periods of danger, they are periods of extraordinary opportunity if you know how to approach them. So let me leave you with a simple question as we step deeper into this conversation. Since you already know another recession will come, because it always does, how do you want to face it? Curled up in fear, or ready to take advantage of the rare bargains that only appear during times of chaos? Because the real challenge isn't predicting when the downturn arrives, it's deciding whether you'll be prepared when it does. Most people get recessions completely backwards. The moment the economy starts shaking, they slam on the brakes. They pull their money out. They shut down every plan they had. They go into full-on defense mode because fear takes the wheel. And honestly, I understand why. When you look around and see friends losing jobs, businesses shutting their doors, or the news blasting worst-case scenarios every single day, it's natural to want to retreat. Fear makes everything look bigger, darker, and closer than it really is. But here's the twist most folks never see coming. The part that took me decades of experience, thousands of mistakes, and 14 recessions to truly understand. Recessions aren't just times of loss, they're times when fortunes are built. Let me repeat that more slowly, because it's the key that unlocks this entire conversation. Recessions are when fortunes are made, not when markets are euphoric, not when everyone feels confident, not when stocks keep hitting new highs. No wealth is built when fear is everywhere. Think of it like this. If your favorite store suddenly put everything on sale for 50, 60, even 70% off, you'd stock up, right? You wouldn't run away, you'd fill the cart. But in the stock market, people do the exact opposite. When prices fall, they panic. They sell what they should be buying. They run from the very moment they should be leaning in. That's the tragedy of emotional investing. Fear blinds people right when opportunity is staring them in the face. And this is where the real separation happens. Some people freeze. And a small number, the ones who prepared, step forward. So here's the big question that should be lingering in your mind right now. If recessions are full of opportunity, why do so many people still get crushed by them? The answer becomes crystal clear when we look back at one of the worst economic collapses of modern times, 2008. Because in that storm, you could see exactly who understood the moment and who didn't. Back in 2008, the world felt like it was falling apart in slow motion. Every headline screamed disaster. Banks were collapsing. Families were being pushed out of their homes. Companies that once looked indestructible were suddenly begging for survival. I remember waking up each morning, turning on the news, and the story never changed. Bad. Worse. Even worse. It felt like the entire financial system was cracking right under our feet. And you know what? People were terrified. Not just beginners, not just casual investors. I'm talking about seasoned professionals, smart people with decades of experience. They were panicking just like everyone else, scrambling for the exits. But while the world was sprinting away from the fire, I chose to walk toward it. Right in the middle of the chaos, I wrote an op-ed for the New York Times. The title was simple, almost stubborn: Buy American. I am. People thought I'd lost my mind. How could anyone talk about buying when everything was falling apart? How could anyone stay calm when the entire planet was shaking? But I wasn't relying on hope. I wasn't guessing. I wasn't trying to be a hero. What I saw clearly, calmly, was something deeper than the fear. I saw value hiding underneath all that panic. I saw good businesses, strong, profitable companies, getting priced as if they were seconds away from disappearing. And I knew fear was pushing prices far below what those businesses were truly worth. So I invested. I bought into Goldman Sachs, General Electric, Dow Chemical, Swiss Re. I put billions to work while others were pulling billions out. And here's what happened next. Those investments didn't just recover. They produced extraordinary returns. They generated billions of dollars for Berkshire. Not because I'm smarter than everyone else, but because I wasn't ruled by the same fear that froze the world. See, that's the thing about recessions. They push even the most experienced investors into emotional decisions. They make people forget everything they've learned. They turn logic into noise. But for those who prepare, for those who study and stay patient and understand what they're looking at, recessions become rare windows of opportunity. And that leads to the real question: how do you actually prepare yourself so you can act calmly when everyone else is panicking? Because buying in a downturn isn't luck, it's strategy. A strategy built long before the crisis ever arrives. If you want to take advantage of a recession, not fear it. You can't just wake up one morning, see the market falling, and suddenly decide to be brave. That's not how it works. Courage in the middle of chaos comes from preparation long before the chaos hits. So let's break down the first pillars of the strategy, the same steps I've relied on for decades. 1. Cash comes first. I know we talk a lot about how cash loses value over time. And that's true. During normal years, inflation quietly eats away at it. But a recession isn't normal. It's a completely different environment. When the market falls, when businesses get marked down like clearance items, when the world is too scared to buy anything, cash becomes your opportunity engine. You need what I call dry powder. Money that isn't tied up, money that's ready to move when prices drop, money that lets you act while others can only watch. And here's the truth. If all your money is locked in long-term positions, you'll miss the moment. You'll just sit there helplessly watching the market slide. So what's the right amount of cash? It depends your age, your job security, your risk tolerance. But as a rule, I recommend keeping at least 6 months of living expenses on hand, more if your income isn't stable. And beyond that, keep a separate pool money specifically set aside for investing when the world goes on sale. People used to criticize me for holding huge amounts of cash at Berkshire. Warren, why are you sitting on a mountain of money? Put it to work. But I wasn't being lazy. I was being patient. Because when 2008 hit, I didn't have to scramble. I was ready. That's the power of cash in a recession. It gives you the ability to say yes right when everyone else is forced to say no. And cash is only the beginning. 2. Make your shopping list before the storm. When a recession hits, emotions run wild. Fear gets loud. Panic gets louder. And trust me, trying to make good decisions in that state is almost impossible. That's why you need to prepare before the downturn arrives. Sit down while the market is calm and your head is clear. Research the businesses you admire, the ones you'd love to own if prices dropped. Companies with strong brands, real cash flow, solid balance sheets, and durable competitive advantages. Not junk, not hype, not cheap-looking businesses that are cheap for a reason. I'm talking about great companies at temporarily low prices. Create a list, 10, 15, maybe 20 businesses. Study them until you understand them inside and out. Know what they're worth long before the crisis arrives. Because when the market tanks, when people are screaming, when prices are falling so fast it makes your stomach knot up, you don't want to think, you want to execute. That's exactly what helped me during one of the most famous opportunities of my early career. 3. The American Express lesson. Back in 1963, American Express faced the salad oil scandal. The stock crashed. The headlines were awful. Investors were running away. But I knew the company, I knew the brand, I knew the scandal had nothing to do with the core business. So I put 40% of my partnership's money into it. It sounded crazy at the time. People thought I'd lost all sense, but I wasn't reacting to the noise, I was reacting to the value. That investment paid off for decades, because preparation gave me confidence when fear tried to take over. And that confidence becomes impossible to maintain if you do one thing, one mistake that destroys investors faster than any recession ever could. That mistake, using borrowed money, and that's where we're headed next. If there's one rule I wish every investor tattooed on their mind before a recession hits, it's this: never ever invest with borrowed money. I'm serious. Leverage is the silent killer of good investors. It looks harmless when everything is going well, but the moment the tide goes out, it exposes every weakness you didn't know you had. During boom times, borrowing feels easy. Stocks are rising, the economy looks strong, and people convince themselves they've found a shortcut. They tell themselves it's smart leverage or temporary borrowing or just a little margin. But here's the brutal truth. When the market drops, when stocks fall fast, when chaos hits, the lenders don't wait for you to recover. They want their money now. Margin calls don't care about your long-term plan. They don't care how good the business is. They don't care what price you paid. If the value of your account falls far enough, you're forced to sell. And worst of all, you're usually forced to sell at the bottom. I've never used leverage in my personal investments. Not once. Because I've seen what it does to people. You can make smart decisions for decades, but one margin call during one downturn can wipe out everything. And once you're wiped out, the game is over. You can't compound anymore. A perfect example was long-term capital management in 1998. The firm was run by some of the brightest minds on Wall Street. They had complex models, Nobel Prize winners, and endless confidence. But they also had enormous leverage. And when the Russian debt crisis hit, their entire system collapsed. The smartest people in the room were taken down by the simplest mistake. So rule number 1, don't borrow to invest, ever. 4. What real diversification looks like. People often misunderstand diversification. They think it means owning a little bit of everything, a huge basket of random stocks just to feel safe. That isn't diversification, that's confusion. Real diversification is owning a small number of strong businesses you truly understand, companies in different sectors with different risks, different strengths. Maybe 10, maybe 15, rarely more. Each one should be a business you'd be comfortable holding for at least 10 years. Something with real durability, real earning power, real fundamentals. Because here's the thing about recessions, they never hit every industry equally. Some sectors get crushed. Cyclicals, travel, luxury goods, certain financials. Others stay steady utilities. Consumer staples, essential services. During 2008, while banks were collapsing left and right, my holdings in companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble kept generating steady cash. People don't stop brushing their teeth or buying soap just because the economy is struggling. And that stability matters. When part of your portfolio stays strong, it gives you the confidence to buy beaten-down opportunities in other sectors. Diversification isn't about owning more. It's about owning wisely. 5. The balance sheet test. Now we come to one of the most critical filters during a recession, the strength of a company's balance sheet. A great business with too much debt can still die in a downturn. A mediocre business with low debt might survive. And a strong business with solid cash reserves, that's the one that comes out stronger. Before you buy anything in a recession, look at 3 things. How much debt do they have? Can they pay their bills even if revenue drops 20-30%? Do they have real cash flow, not just adjusted earnings? If the answer isn't crystal clear, move on. Think back to the 2008 banking collapse. All banks suffered, but not all banks were equally weak. J.P. Morgan under Jamie Dimon had been managed conservatively. They had capital, they had liquidity, they had discipline. So, while some banks disappeared, J.P. Morgan survived and came out stronger. That's the power of a strong balance sheet. During a recession, weak companies vanish, strong companies expand. And identifying the survivors is only part of the mindset you need. Because even with the right companies, the right strategy, and the right preparation, you still need one more ingredient. Something deeper. Something that shapes how you make decisions long after the headlines fade. And that ingredient is learning to think in decades, not days. Most people underestimate just how powerful long-term thinking really is. They look at the stock market like it's a daily voting booth, up today, down tomorrow, unpredictable and emotional. But that's only the short-term view. When you zoom out, when you look at the economy like a 20 or 30-year story, something becomes incredibly clear. Recessions are temporary. Real growth is permanent. I like to explain it with a simple example. Imagine you buy a good farm, fertile soil, reliable crops, fair price. Now imagine that the very next year a drought hits, yields collapse, farmland prices fall. Does that mean the farm is worthless? Of course not. You don't panic. You don't sell. You wait because you know the land will produce again when the conditions change. That's how I see great businesses. They're not lottery tickets. They're not paper slips you trade like baseball cards. They're productive assets that grow over time, even if a recession knocks them around for a while. That's why when I bought Coca-Cola back in 1988, I didn't care about the recessions that came after. The tech bubble, the financial crisis, the pandemic. I didn't sell because I didn't buy Coke for next week. I bought it for decades. Ben Graham, my teacher, summed it up perfectly. In the short run, the market is a voting machine. In the long run, it's a weighing machine. And I've lived long enough to see exactly how true that is. 6. Live below your means always. Now let's talk about something that people really don't like hearing: lifestyle. If you're living paycheck to paycheck, if every dollar you earn is already committed, you simply can't prepare for a recession. You can't save. You can't invest. You can't take advantage when opportunity shows up. One unexpected bill and everything comes crashing down. I've lived in the same house since 1958. It's a comfortable place, not a palace, not a monument, just a home. I drive a regular car. I don't own yachts or fancy art collections. And it's not because I can't afford them. It's because they don't add anything meaningful to my life. What does add meaning is security, knowing that no matter what the economy does, my family will be fine. I've watched high earners, doctors, executives, lawyers, make hundreds of thousands of dollars a year and still have no savings. Every time they get a raise, they upgrade their lifestyle. Bigger house, new car, nicer vacations, and their bank account never grows. That's lifestyle inflation, and it's a trap. If your income rises and your lifestyle rises with it, you never create the cushion you need. But if your income rises and your lifestyle stays the same, that's where wealth grows. That's how you prepare for downturns. That's how you sleep well at night. Because recessions punish those who overspend and reward those who prepare. 7. Protect your mind. Limit the noise. During recessions, there's another danger people forget about, and it's not financial. It's psychological. The news media thrives on fear. When things get bad, the headlines get louder. Doom sells. Panic sells. And if you sit there glued to the TV or scrolling nonstop, your mind fills with worst-case scenarios. It becomes almost impossible to think clearly. Now, don't get me wrong, staying informed is important, but obsessing over every headline, that's a recipe for emotional decisions. And emotional decisions are the enemy of smart investing. So here's what I do. I check the news once, I get the big picture, then I shut it off. Because the only thing that really matters is what the businesses I own are doing, not what someone on TV predicts will happen next week. During the dot-com mania, everyone told me I was missing out, that I didn't understand the new economy. The media couldn't stop hyping it, but the businesses had no earnings, no fundamentals, no real value. I tuned out the noise, and when the bubble burst, I was glad I did. Filter the world, protect your mind, stick to the fundamentals. And once you cut through that noise, there's one lesson that becomes absolutely essential: the difference between price and value. One of the most important lessons I ever learned came from Ben Graham, and it's simple enough to fit on a sticky note. Price is what you pay. Value is what you actually get. Those two numbers can look similar in good times, but during a recession, they can drift miles apart. Let me show you what I mean. Imagine there's a business that earns $10 million a year, steady as a clock. In a healthy market, investors might value that company at around $150 million. But during a recession, fear floods the system. People panic. Stocks get sold off, not because the business changed, but because emotions changed. Suddenly, that same company might be trading for $80 million or $60. Nothing about the core business shifted, just the mood. That gap between price and value, that's where opportunity lives. Recessions stretch that gap wider than any other time. And if you can train yourself to look past the falling price and focus on the true worth of the business, you set yourself up for extraordinary long-term returns. But here's something investors don't talk about enough. Once you actually make money from these opportunities, what do you plan to do with it? 8. Have an exit plan, but not the kind you think. When I say exit plan, I don't mean selling the moment the market dips. I don't mean panic exits. I don't mean trying to protect yourself from every bump. An exit plan simply means knowing ahead of time how you'll use your gains. Are you building for retirement? Funding your child's education? Pursuing financial independence? Growing a long-term portfolio you plan to hold for life? Your goals will guide your decisions far better than the headlines ever will. Personally, if I own a truly exceptional business, I prefer to hold it, sometimes forever. But some people like to rebalance. Some like to take profits. Some like to diversify more as they get older. All of those can be perfectly reasonable choices as long as they're intentional. Investing without a goal is just gambling with a nicer vocabulary. 9. Don't try to pick the exact bottom. Now let's clear up a huge myth. You will not time the bottom. Neither will I. Neither will Wall Street experts. No one can do it consistently. And trying to do it usually leads to paralysis. People wait and wait and wait, hoping for the magical, perfect moment. By the time they finally feel safe, the recovery has already begun. The best prices are gone. My approach is simple. When the market is clearly cheap, when fear is high and prices are falling, I start buying. Not all at once, a little at a time. If prices drop further, I buy a little more. If they drop again, I buy again. It's like walking down a staircase instead of jumping from the top step. You don't need perfection, you just need consistency. Because in a recession, being roughly right is far better than waiting forever to be perfect. And if you want to get better at seeing these moments clearly, better at recognizing patterns, better at avoiding old mistakes, you have to understand the past. Because history may not repeat perfectly, but it rhymes loud enough for anyone paying attention. Every recession has its own storyline, its own triggers, villains, and headlines. But underneath those differences, the patterns are surprisingly familiar. That's why I always tell people study the past, not to predict the future, but to recognize the signals when they appear. Look at the Great Depression. Deflation made cash incredibly valuable. People who held on to money rather than panicking into risky bets did well. Then jump ahead to the 1970s. Inflation was the monster that time. Cash lost value fast. People who kept everything in savings got crushed as prices soared. Move to 1987. The market fell so fast, it looked like the financial system had been unplugged overnight. Then the tech bubble in 2,000 companies with no earnings, no profits, no real business model valued at billions. And, of course, 2008, a credit crisis so severe, it shook the foundations of the global economy. Each recession had a different cause, different players, different emotional tone. But the core principles for surviving and thriving never changed. Own strong businesses, avoid debt, think long-term, buy when others are fearful, stay disciplined. When you study history, you stop being surprised by downturns. They become expected, predictable in their unpredictability. And because you expect them, you don't freeze up when they arrive. 10. Courage, the rare skill that changes everything. Now we get to the part most people underestimate. You can know everything. You can build cash reserves, prepare shopping lists, Study balance sheets, understand value, plan for the long term. Do all your homework, and still fall apart when fear hits. Because when the market is crashing, when the headlines are screaming, when everyone around you is panicking, it doesn't feel like opportunity. It feels like danger. This is the moment where most investors fail, not because they're unprepared, but because fear wins the battle in their mind. So how do you build courage? You rehearse it. You visualize the downturn before it happens. You imagine the fear. You imagine the falling prices. You imagine everyone saying, "This time is different." And then you picture yourself staying calm, executing your plan, following your research instead of your emotions. When the real storm arrives, it won't feel completely new. You've been there in your mind already, and that familiarity gives you just enough strength to take action when it counts. 11. The final ingredient, patience. People love the excitement of buying, but the real wealth comes from waiting. When you buy during a recession, the market doesn't shoot straight up the next day or even the next year. It wobbles. It dips again. It tests your confidence. And most people can't handle that. They bail out too early. But investing is like planting an oak tree. You put the seed in the ground, you water it, you protect it, but you don't dig it up every weekend to check if it's growing. You give it time. One day, years later, you look up and see something strong, steady, and undeniable. That's what patience creates. That's what compounding rewards. That's what recessions offer to those who stay the course. Closing the choice is yours. Recessions will come. I don't know when. No one does. But they're guaranteed. And when they do, you'll face a choice. You can panic, sell everything, follow the crowd into fear, and watch opportunity pass right by you. Or you can prepare, build your cash reserves, study great businesses, avoid debt, think in decades, live simply, stay level-headed, and step forward while others are stepping back. I'm 95 now. I won't live to see many more recessions, but you will. You'll have decades of cycles ahead of you, decades of moments the world will call crisis, but you'll know are actually windows of opportunity. And if you prepare now, you won't just survive the next downturn. You'll flourish because of it.